thank you very much for having me. So today I'm going to be talking about why traders pay too much in taxes. But before I get into the meat of that, I do have a couple of disclaimers that I've got to go through. The first is that tax law is changing constantly. We do make every effort to keep this presentation as up to date as possible. But before you rely on the information that I present here today, I do recommend consulting with either a tax attorney or a tax accountant like Traders Accounting. The second thing that we ask you to keep in mind is that Traders Accounting is not a law firm. So none of the advice given here should be considered legal advice. What Traders Accounting is an accounting firm. And for 16 years now, we've been helping traders with all aspects of trading and taxation. This includes helping traders set up business entities to trade through to recognize some of the tax benefits of trading as a business, helping traders with their entity tax preparation as well as personal and estate tax preparation, helping them with monthly bookkeeping, coaching to ensure that they're operating these business entities properly, as well as helping traders handle their retirement needs through self-directed 401k plans and estate planning needs through revocable living trusts. As you can see, we really try and live up to our motto, you trade and we do the rest. If you'd like to find out a little bit more about who we are and what we do, we invite you to check out our website at www.tradersaccounting.com. Give us a call at 855-334-7936. Email us at learn@tradersaccounting.com. And we also invite you to check out our blog, the address of which is at the bottom of the screen. Now, we will have time for some questions and answers at the end of today's presentation, but we do have quite a bit of material to run through, and I'm going to be going through it quickly. So if you have any questions about anything, please just type them into that question comment box as those questions come up, and at the end of the presentation, we'll answer as many of those questions as we have time for. To begin with, we've got to start with some pretty bad news. In the eyes of the IRS, you are considered an investor. And from the tax perspective, this is a terrible thing to be. And this is the default status for you with the IRS. They are going to be treating you as an investor unless you take affirmative steps to change this status. Now, as an investor, you're paying more in taxes, have complicated filing requirements, and have to deal with some major tax issues that can cause you to pay much more in tax at the end of the year than you should. Now, the common sense definition of investing is pretty simple: committing money or capital to an endeavor with the expectation of making a profit. This is not the definition that the IRS uses. In the eyes of the IRS, an investor is someone who buys and sells securities and expects income from dividends, interest, or capital appreciation, with a focus on long-term income building rather than the short-term act trading that many of you listening today will be using. They also specifically indicate that investing is not a trade or business, which limits your ability to deduct expenses related to investing. Now, it doesn't matter what you call yourself. Investing is the default tax status for you unless you take some affirmative steps to change how the IRS is going to view you. And as an investor, the tax code is most definitely not your friend. It has some major effects on how you report income from your activities, and it has some major effects on how you deduct expenses related to producing income through trading. And we'll start by running through the income side of the equation. And so for investors, there are really three different categories of income treatment. There's capital gains, capital losses, which is going to apply to stock and stock options. Ordinary income tax treatment, which applies to Forex trading, and Section 1256 treatment, which applies to futures, broad-based index options, and some ETFs. Now, the capital gains structure is the default for stock and stock options. But really, just about everything you own and use for personal purposes, pleasure, or investment is considered a capital asset. And the IRS prefers that you hold assets for long term. So anything you're holding longer than a year is considered long-term capital gains, and it's taxed at either 0, 15, or 20%, depending on your income tax bracket. Anything you're holding less than a year is considered short-term, and this is taxed at the ordinary income tax rate. When it comes to reporting your capital gains activity for the year, you do so on Schedule D of your individual 1040 tax return. And most traders simply rely on the 1099-B they receive from their broker in order to prepare that Schedule D. Unfortunately, you just can't do that because 1099-Bs often miss required information that you need for properly reporting your taxes. For each transaction, you need to have the number of shares, the name of the stock, purchase price, sales price, date sold, and date purchased. And unfortunately, those 1099-Bs often lack one bit of this information. It's also pretty time-consuming to fill out that Schedule D if you've got 25 trades. But if you're more active with 600 or 1,000 trades, that Schedule D becomes incredibly complicated to make sure you're filling it out properly. But this isn't the big issue when it comes to capital gains and capital losses, because with these trades, you have to worry about the wash sale rules. And the wash sale rules are one of the two main tax issues that cause investors to pay more in taxes. A wash sale occurs whenever you sell a security at a loss, then within 30 days, either before or after the date of that sale, you purchase that same security or substantially similar one. And for the purposes of the wash sale rule, a substantially similar security includes any option that's on the same underlying security. And when a wash sale occurs, the loss on that initial sale is disallowed, and the basis of the replacement stock is adjusted to carry that loss forward. And to give you an example of just what this looks like in practice, we've got an example of a trader who owns Microsoft at $25 a share. And at the end of the year, they go ahead and sell it at $23 a share and take a loss of $2 per share. But because they like Microsoft, they like the dividend, for whatever reason, they go ahead and get back into it on January 1st of the next year. Here we have a wash sale, a sale at a loss, then within 30 days, a repurchase of a substantially similar security. As a result, that loss gets disallowed, and the basis of the replacement stock gets stepped up to carry that loss forward. As you can imagine, this is a bit of a headache to keep track of through bookkeeping throughout the year. But the biggest issue with wash sales is highlighted when the wash sale occurs over the end of the year like this, because that loss that you should be deducting in 2014 is now carried forward to 2015, leaving you paying tax on income in 2014 that should have been offset. Now, these wash sales can also show up unexpectedly, because trading in any account under your Social Security number can trigger those wash sales. This includes trading in qualified retirement accounts. So if a wash sale is triggered by a trade in your IRA, you have the possibility of losing that loss really forever. So with these wash sales, they can have some pretty serious effects on the taxes you're paying. Because if you misreport a wash sale, you end up misreporting income on your tax return. This misreported income leads to additional tax paid, as well as the possibility of penalties and interest, and the need to go back and amend your previous year's tax return, which is an additional time and expense having that amended return prepared. And as an investor, you have to worry about those wash sale rules. You also have to worry about the $3,000 capital loss limitation. And this one's relatively straightforward. You can only deduct $3,000 of capital loss against ordinary income in any given year. So in this example, we've got a trader who has a W-2 income of $100,000, then a terrible trading year, and have a capital loss of $100,000. Most people would look at this and say, oh, you made $100,000 and you lost $100,000. No taxable income for the year. But the IRS is not most people. And because of this $3,000 capital loss limitation, you're left with taxable income of $97,000 in that first year. The remainder of the capital loss is carried forward, and you are able to use it to offset future profits. But if you get locked into that $3,000 per year, you can see it's going to take quite a while to write off that entire trading loss. So the wash sale rules and the capital loss limitation rule are the two big issues that face investors that work with stock and stock options. But there are different types of taxation that can apply to your trading activities. And these do apply whether or not you're considered an investor or an active trading business by the IRS. The first is the 1256 taxation. And 1256 taxation applies to futures, broad-based index options, some ETFs, E-minis, and things of this nature. Really any non-cash settled option. And under Section 1256 taxation, your net gain from the year, 60% of it is taxed as long-term capital gains at that lower tax rate, and 40% is taxed as short-term capital gains, regardless of your holding period. So with these 1256 contracts, you do see a lower default tax rate on income. They're also substantially easier to report to the IRS. You simply report the broker and the net gain or loss on Form 6781, but there's no requirement to document each trade like you would with those capital gains and capital losses. Futures contracts and other 1256 contracts are also by default exempted from the wash sale rule. So with these 1256 contracts, if you have anything open at the end of the year, it's marked to market, considered sold as of December 31st, than as if you'd repurchased it on January 1st of the following year. So the 1256 contracts have a lower tax rate, and they're already exempt from those wash sale rules. They are still subject to that $3,000 capital loss limitation. The third type of taxation that investors can face is what Forex is subject to, Section 988. And Section 988 gives Forex trades default ordinary income, ordinary loss tax treatment. So by default, Forex traders are not subject to that $3,000 capital loss limitation, and they're not subject to the wash sale rules. But there is another option with those Forex contracts. You can elect on a trade-by-trade basis to have them taxed under Section 1256, giving your Forex trades that lower 60-40 split tax rate. This election does need to be made at the time you open the position, and the IRS discourages cherry picking for making that election. So as an investor, under the tax code, your income treatment is locked into some pretty specific rules. Your gain or loss from trading is reported through Schedule D. You have to worry about those wash sale rules. You have to worry about the effects of the $3,000 capital loss limitation. And you have to worry about making sure that both your 1256 and 988 contracts are reported properly on your individual tax return. And this is just one side of the equation for investors. The other is deducting expenses. And as you trade more, as you spend more time on education, on data fees, on services, your expenses related to trading are going to increase. So the question becomes, are you able to deduct those expenses you pay for your trading activities? Looking at our clients, we see the following areas where expense shows up. Computer equipment for your trading activities, especially 6-monitor setups. Office furniture for the home office, using your personal vehicle for business purposes, dues and subscriptions for platform and data fees, trading organizations, periodicals, things of that nature, educational expenses, repairs to your computer equipment, expense related to keeping an office space or home office, bank service charges, office supplies, software, utilities like telephone, internet, and TV, professional fees related to tax prep and accounting, then travel and entertainment related to attending educational events and other trading activities. As an investor, you can deduct almost none of these. The only ones that are still available to you are the dues and subscriptions deduction, the bank service charge, and professional fees for tax preparation. But even though these are severely limited, you almost can't deduct any of them. The ones that you can deduct are also subject to a 2% AGI threshold limitation, which means you can only take the portion of those expenses that exceeds 2% of your yearly gross income. So as an investor, you are going to be paying more in taxes. When it comes to your income, you have to worry about issues with that $3,000 capital loss limitation and the wash sale rules preventing you from deducting losses in the year in which you take them. And you have to worry about the fact that you cannot take deductions related to the majority of your expenses related to trading. So as an investor, you have a couple of options. The most important thing to do is make sure that you're working with a tax professional who is familiar with traders' taxation. So you're certain that you're taking proper advantage of things like the 1256 contracts, the 1256 election for Forex contracts, and making sure that the deductions you can take are being taken on your tax return. And make sure that they're familiar with the wash sale rules and how those are going to affect your taxes. And at Traders Accounting, we do work with investors. We help them with their record keeping, tracking their trading activity, as well as those expenses related to trading, help them prepare their tax returns at the end of the year, help them figure out what their actual wash sale numbers are and making sure those are reported properly, and then we consult with them on their questions and tax issues. But this isn't really the best situation. We still don't like that investor tax status. So the other choice for investors is changing how you are going to be taxed. And when it comes to your trading, if you change your methods of operation, if you take affirmative steps to change how you're carrying out your trading activities, you can change how you're going to be taxed. And this does require affirmative steps, but the goal is to be viewed by the IRS as a trading business, allowing you to receive the benefits of being taxed as a business is. By changing how the IRS views you, by taking the steps necessary to be viewed as a trading business, you can change how the IRS is going to allow you to treat your income from trading. Now, we ran through the defaults, the capital gain and capital loss for stock and stock options, 1256 for futures, and 988 for Forex. But when the IRS views you as a trading business, you get another option. And this is mark-to-market accounting, which is only available to you if you are being taxed as a trading business. The mark-to-market election is an overall change to your accounting method. It converts any capital gain and capital loss that you see to ordinary income and ordinary loss, which means that the mark-to-market election exempts you from the effects of the $3,000 capital loss limitation. It also exempts you from the effects of the wash sale rules. So by making the mark-to-market election, you effectively protect yourself from those two main tax issues that face investors. Like those 1256 contracts, if you have any open positions that you've made the mark-to-market election for, they are marked to market at the end of the year, considered sold for tax purposes as of December 31st, keeping all gain and loss in the same year. This election is enormously powerful in protecting you from the negative tax treatment that investors face. And as such, it must be made properly to ensure that it's going to affect your trading and keep you from dealing with the capital loss limitation and the wash sale rules. For an existing trading business, this means that the election must be made by the last unextended day to file your taxes for the previous tax year. So if you're currently trading as a Schedule C business or as an LLC or C Corp, well, actually C Corp deadline is passed for the year, but as a Schedule C trading business or an LLC, the deadline to make the mark-to-market election for 2016 is coming up on April 15th. On the other hand, if you're starting a new trading business, you can make the mark-to-market election at the point where you create that business itself, putting it in place at any point throughout the trading year. The question also comes for the mark-to-market election, is it going to be the right choice for your trading activities? It's an important note that the mark-to-market election is not mandatory for a trading business. It's an option that only trading businesses can take. And the mark-to-market election is hugely beneficial if you trade with stock or stock options. But it's not terribly great if you trade anything else, because by making that mark-to-market election for futures contracts, you would lose the benefit of that lower tax rate. And for the Forex contracts, you lose the ability to make the 1256 election on a trade-by-trade basis. It's also not terribly great if you have a large personal loss carry forward from previous years, because by making that mark-to-market election, you are effectively converting your largest source of capital gains for future years, your trading activity, into a source of ordinary income, which would, in effect, lock you into that $3,000 per year write-off for your capital loss carry forward. So as a trading business, you have some incredibly beneficial steps you can take when it comes to the treatment of your trading income. You also gain quite a few additional deductions that you can take against that income. Because as a trading business, you can deduct any ordinary and necessary expense related to your trading activities. You can also look back and deduct expenses related to running that trading business as well. And so if you think back to my list of deductions from before, as a trading business, you can deduct every single one of these. When you're operating the business, as well as looking back for a period of about 15 months before you establish that business as well, bringing all those deductions into the business and taking them as deductions for your individual taxes. To take these deductions, you need to have a couple of things. The first is substantiation of the amount you actually paid for those expenses, which is a matter of keeping up with monthly bookkeeping. The other is that you need to be viewed by the IRS as a trading business and operating as a trading business would. I mentioned this before, but if you establish a trading business in the current year, you can look back at least 12 months and usually out to about 15 to recapture expenses you paid in that time related to trading. So even if you took an education course last year, you can still deduct the expense of that education course. Up to $5,000 is taken as an immediate one-time deduction, and then any excess is amortized over 15 years. But you are able to take the benefits of those expenses in the current year, even if you were prevented from deducting them in past years. So if you're trading at the next level, if you're trading more actively, you may qualify to be taxed as a trading business. And this is a great thing, because as a trading business, you get to take more in deductions and provide more benefits to yourself as the owner of a small business. In the eyes of the IRS, if you are a trading business, this is known as being taxed as a trader in securities. And the requirements of being taxed as a trader in securities are set forth in IRS Publication 550, which gives the special rules for traders in securities. It puts forth 3 tests, and they look at all of the trading occurring under your own Social Security number. They do leave out trading in qualified retirement accounts. So this would be only the trading being carried out in your taxable account. And they really look at whether or not you're trading like a business, whether you're operating like a business would. And this goes beyond the psychology that many educators talk about. They look at whether or not you're following the actual formalities of operating as a small business. The IRS publication gives us these special rules for traders in securities. And it sets forth 3 requirements that your trading needs to meet in order to be taxed as a business. The first is that you must seek to profit from daily market movements in the price of securities and not from dividends, interest, or capital appreciation. Essentially, you're looking to those short-term profits rather than the long-term investing that the IRS really built the tax code around. Second, your trading activity must be substantial. And third, you carry on your trading activity with both continuity and regularity. The IRS doesn't give us hard standards that you need to meet in order to qualify. Instead, they tell us the facts and circumstances that they'll consider when determining if you've met these requirements. So in order to tell if you're looking to profit from those daily changes in market price, they look at the holding periods for what you're buying and selling. In order to determine if your trading is substantial, they look at both the frequency and dollar amount for your trades during the year. And in order to determine if you're trading with continuity and regularity, they look at the amount of time that you devote to the activity. So we've taken a look at the tax court cases where traders have tried to qualify as a trader in securities. And we've come up with a couple of rules of thumbs to ensure that you meet these requirements. First, you are active on at least 80% of the available trading days throughout the year. And what we mean by active is placing at least one trade on each day. Now, it's not quite as dry as that. If you place 5 trades on Monday and no trades for the rest of the week, it's effectively the same as trading on each day. But the big thing here is that you are active continuously throughout the year, not trading for a couple of months and then taking the rest of the year off. By doing that, and at the same time operating as a business, following the business formalities, you can ensure that you're qualifying for that trader in securities tax status and qualifying for the tax benefits you receive as a trader in securities. Now, this third requirement is one that can be a little tricky because, as I mentioned before, we hear trade like a business from a psychological perspective quite often from educators. And that's very important to your success as a trader. But beyond that, when it comes to trading like a business in the eyes of the IRS, they want you to be operating as a business should, which includes choosing the right structure for your circumstances, keeping compliant with any requirements that pertain to that business structure, and keeping up with monthly bookkeeping. And you may notice me come back to this requirement several times throughout the presentation, because it is one of the most important factors we see when the IRS is determining whether a small home-based business is going to be qualified as a business or considered a hobby, whether or not you're keeping your books on a monthly basis or using some other less frequent bookkeeping method. When it comes to the right structure for a trading business, you have quite a few options, and each of them has benefits and each of them has some drawbacks. The structure that you start out with originally can be changed, but the conversion to another type of structure can have tax consequences, particularly if you look at going from a C corporation into another type of entity structure. The first and probably easiest structure to work with is the Schedule C trading business. And this is also known as trading as a sole proprietorship. It's just a different name for the same tax status. And it is by far the easiest to set up, because when it comes to a Schedule C trading business, all you need to do is file a Schedule C with your individual tax return and report your expenses on that Schedule C. So this is pretty good. It gets you those benefits of the deductions, and it's very easy to create. However, there are some substantial drawbacks to operating as a Schedule C trading business. The biggest is that we see Schedule Cs get audited much more often than traders who work with other types of business entities. And because it's part of your individual tax return, it's much harder to keep separate from your individual taxes. And things like commingling personal and business expenses, commingling long-term investing you do on a personal level from your active trading business can act to really destroy this structure and leave you without the benefits of being taxed as a trader in securities. Also, as a Schedule C business, there's no real ability to provide medical benefits. Instead, it all just gets taken through Schedule A, subject to the 10% AGI limitation. The LLC is a much better entity choice for a trading business, and it's the most common structure we set up because it often is the best choice for a trading business. This is because it is a pass-through entity, which means they completely pass through all items of income and expense to your personal return, meaning you get the benefits of filing as a business, deducting those expenses without any change in how you receive income, no additional payroll taxes, and without having to pay tax at a separate entity level. Now, LLCs are a creation of state law rather than federal, and because of this, they provide limited liability for all members of the LLC, unlike a partnership, which is the standard pass-through entity and the one created by federal law. And when I say that LLCs are a creation of state law, this gives benefits because the IRS treats them flexibly depending on your options. But when it comes to trading, a two-member LLC is going to be the best because this allows you to have your LLC taxed as a partnership, getting that flow through while maintaining the limited liability for all the members. The second member of the LLC is typically going to be your spouse, but it can also be a close friend, another family member, or another business entity like a C corporation or an irrevocable trust set up to act as that second member. But when you have this two-member LLC, all of your profits flow through with the same character of gain onto your personal return. So if you're trading exclusively futures inside the LLC, that income comes out as 1256 gain and reported on your personal return subject to that lower 60/40 tax rate, while still allowing you to deduct those expenses as ordinary deductions. And perhaps the biggest benefit of using an LLC is that you receive these profits without paying payroll tax, unless, of course, you want to pay it. And you may want to do so for the purposes of contributing to a qualified retirement account, but unless you take an affirmative step to change the character of your gain from the trading LLC, you won't pay any payroll taxes. So the LLCs are pretty hugely beneficial to traders, but there are some downsides. And with an LLC, you can't deduct medical expenses. Again, those will just get taken through your personal return, subject to the 10% AGI limitation. The members of the LLC are also going to pay tax on their profits yearly, even if you leave those profits in the entity. But each year you will only pay tax on that year's profits. You will never pay tax again on profits that you do leave in the LLC to use for future trading. And it must have at least two members to be effective for trading purposes. If you do have a single member LLC, it's treated as a sole proprietorship from a federal tax perspective, and so runs into the same issues as a Schedule C trading business. The third commonly used option is a corporation. And with a corporation, which is going to be a subchapter C corporation, the subchapter S corporation is a terrible choice for a trading business, particularly because it subjects about half of your profits to those payroll taxes. But so with a subchapter C corporation, you're able to provide additional benefits to yourself and your family. And this is a standalone business entity, which means it pays taxes at the corporate level, admittedly at a much lower tax rate than you or I pays. Then it pays out wages, dividends, or other means of getting those profits out to you, where you do pay tax on it a second time at the individual level. But with a corporation, it's really the best entity to use if you're going to be paying yourself or your family a wage. And based on that wage, make retirement account contributions on behalf of yourself and your family, typically into IRAs or a self-directed 401k that you also had the authority to trade and direct the investments on. It's also the only entity that you can use to provide medical benefits through a medical expense reimbursement plan. And this allows you to report any out-of-pocket medical expense you have throughout the year to the corporation, reimburse yourself for that expense, then report that medical expense on the corporation's tax return, deducting it 100% against your trading profits without being subject to that 10% AGI threshold limitation like you are for medical expenses you take on your personal return. So when it comes to a corporation, there are several downsides. The first is that it's pretty tricky to take out profits from the corporation without paying payroll taxes. And by paying yourself a wage, you will be required to pay payroll taxes at both the corporate and personal level. The other option for taking out profits from a corporation is a dividend. And when you take a dividend from a corporation you own, you end up paying tax on it twice. Once at the corporate level, then a second time on the individual return. And the other downside is that the corporation does have to pay its own taxes. So it'll end up paying income tax at both the federal and state level, and is often required to make quarterly estimated payments of that tax. It is also possible to combine a couple of these entity structures and receive the benefits of both. For this, we like to use an LLC and a corporation, with the corporation being one of the owners of the LLC and existing to provide those benefits, the medical expenses and the retirement account contributions, as well as pay expenses related to the trading activities. The corporation, as well as the trader, are owners of an LLC, and the LLC is used to generate income and pass profits out to you with no payroll tax due on those trading profits. As part of setting up this structure, we also help balance it so that the LLC is passing just enough income up into the corporation to provide the benefits and pay the expenses without seeing additional tax liability at the corporate level. So by doing this, you get the medical benefits of a corporation and the payroll tax benefits of an LLC working together. We like to use business entities for a trading business because it lets you provide a clear distinction between business and personal trading, particularly long-term investing that you would still do on a personal level. By using these business entities, it gives you a much lower audit risk than from trading as a Schedule C business. And it allows you to recapture and deduct previously paid expenses that you were prevented from deducting in previous years. Once you've established the business, it's important to make sure that you are maintaining that business properly. And for any of the entities we've discussed here, it's going to be relatively simple to keep them active. You need to file annual tax returns at the federal level as well as at the state level. Then for most of these entities, there's also going to be a regular state report letting the state know that you're still in business. And my favorite requirement, the monthly bookkeeping. But when you keep up with all these requirements, when you keep that entity active, it is the safest way to provide yourself the benefit of trading as a trading business. And at Traders Accounting, we do offer services to help traders set up these entities as well as maintain them moving forward. We offer a monthly bookkeeping service, taking a look at your trading activity as well as the expenses you're paying out, making sure that you have books that will satisfy any IRS requirements, and making sure that all of the expenses possible are taken against your taxes. We help traders choose the right entity to use for trading purposes, as well as forming those returns and making sure that they operate them properly moving forward. We help them with the preparation of tax returns for these entities, as well as personal returns. For those traders that have not made the mark-to-market election, we help them with wash sale calculations, making sure those are reported properly. We help traders make the decision to make the mark-to-market election, as well as help them go through the process so that they make that election effectively and properly. and then again consulting for any tax or entity-based questions these traders have. And as part of today's presentation, we do want to offer a free 30-minute consultation to discuss your individual trading situation and which one of these entity structures would be the best choice to use for you. If you'd like to get this set up, you can call or email Raven to schedule. Her number is 800-938-9513, and her email is ravenj@tradersaccounting.com. So I hope I'm able to leave you with a couple of really points that'll help you make better decisions about your taxes, especially as we get closer to the April 15th deadline. To begin with, in the eyes of the IRS, you are considered an investor, and this is the default tax status for everyone. Investors are treated terribly by the tax code. Investors have to worry about wash sales, causing them to carry losses forward to a future year. They have to worry about the $3,000 capital loss limitation, again, carrying those losses forward into a future year. The incredibly limited deductions that investors are able to take against their income. The complicated reporting requirements of Schedule D and making sure that the 1256 and 88 contracts are reported properly. And so if you are going to operate as an investor, make sure that your trading is being reported properly. Make sure that wash sales are being calculated properly, and make sure that the income is being reported so you get the best available tax treatment for your trading activities. But if you take affirmative steps, you can escape this investor tax status. By trading through a business entity, you allow yourself to receive the benefits of being taxed as a trader without having to worry about the audit risk that you would see as a Schedule C. And by doing so, you free yourself from the effects of those wash sale rules and the $3,000 capital loss limitation, protecting yourself from the negative effects of those rules. You also are able to remove the limitations from your deductions, allowing you to deduct 100% of the expense you pay related to trading, as well as look back at the previous 15 months, bringing those expenses forward and deducting them in the year you create that business entity. It allows you to take advantage of the perks of operating a trading business, being able to provide benefits for yourself and your family, and really maximizing the tax efficiency of your trading activities. That's going to finish the substantive portion of my presentation. I know we do have some time left for questions. And so any questions you folks have, just type them into that question comment box, and we'll be able to run through as many as we have time for. Victoria asks, can you be an LLC partnership and take all the other advantages without electing mark-to-market? Absolutely. The mark-to-market election is one that is available to trading businesses, but it is not required for a trading business. And particularly traders that work primarily with things like Forex or futures will have an LLC to use as a trading business without making that mark-to-market election. Bill asks, is there a best time of year to set up a business? How much lag time should one build in? And there's really not a best time of the year to start a business, although I will say once we get into November, December, it often makes sense simply to hold off until January to get things set up. And then the lag time is going to vary from state to state. Arizona, it takes 7 to 10 days to get things put together, whereas there are some states that take 2 or 3 months. But that's an excellent question for that free 30-minute consultation I mentioned earlier. Michelle asks, what about Nadex binary options on futures, mark-to-market 1256 or wash sales? With the binary options, they end up taxed the same as the underlying contract. So for those binary options on futures, we do look at the 1256 tax treatment for those options. So for those, we would not make the mark-to-market election, and they're not subject to wash sales. Kim asks, what's the best option to use if you trade both Forex and options? And for a situation like that, it's actually the best treatment to make the election such that it applies only to the stock and stock options trading while exempting your Forex contracts. And it's possible so long as the election itself is worded properly to exempt anything that might be subject to 1256 tax treatment or 988 tax treatment. Peter asks, how is the cost of setting up an LLC tax deductible? And so with the formation of an LLC, on the first tax return for that business, you would deduct all the expense related to setting up that business itself, as well as any expenses you paid for the previous 15 months. And you just receive both of those deductions along with the first tax return you filed for that business. Larry asks, I trade a substantial account, but I don't achieve the trader tax status as a swing trader. Would it be of any benefit tax-wise to establish an LLC? And we do have a number of clients that do swing trade while qualifying for the trader tax status. It does depend quite a bit on the continuity of trading and just how things are looking for you. But if you don't rise to the level of that active trader, then setting up the LLC doesn't provide too much benefit for you. But for a situation like that, I would definitely recommend taking advantage of that free 30-minute consultation so we can get a little bit more in detail on just what your trading looks like. See, and I'm seeing a couple of questions along a similar vein. So the 30-minute consultation I mentioned earlier, it's a half an hour for you to discuss your individual situation, how you trade, what sort of profits you're seeing, what your needs are as far as benefits, and based on that information, recommending to you the right entity structure, as well as mark-to-market, what type of taxation would be best for you. And so that free 30-minute consultation is really intended to make sure that you're getting the best entity structure for your individual situations. Let's see, and there are some excellent questions here that are just a little bit beyond the scope of what we can get into in this format. So if I'm not answering your question, it's not because I don't see it, it's because it's just a little bit too complex for us to get into in the webinar format. Let's see, Bob asks, still have losses to carry over. How is it best to treat that if I go to a trader tax status? And with that, it depends on the size of the loss and the type of trading that you'll be doing. But generally speaking, if you do have a large capital loss you're carrying forward, then it may make sense to not make the mark-to-market election so that your future trading profits would still be capital in nature, and you can offset them with that carried forward loss. EW asks, bank service charges are tax deductible. Does that include fees and commissions on that trade? And absolutely. As a trading business, you're able to deduct any commissions you pay when you're actively trading. This includes the trade-by-trade commission, but also any other sort of brokerage or bank fee that your broker is going to be charging you. See, one other question that I do get pretty often is whether or not setting up this LLC in the state you live in is going to be the best idea. And there are some states out there where it does make sense to set up the LLC elsewhere. However, there are some states like California where so long as you live in the state, even if you are creating an LLC elsewhere, you're still going to be subject to the minimum taxes that California assesses against business entities. And so the state choice is going to vary quite a bit depending on which state you live in and which state you're looking at setting up in. Well, one of the more recent cases that came through with regards to the trader tax status was one that had some pretty interesting ramifications when it comes to qualifying as a trader. And it really highlights the advantage of operating through a business entity as opposed to as an individual. And the case in question was Endicott v. Commissioner. We had a trader who had more than 1,000 trades during the year in question. And he filed as a trader in securities based on that. As a result of this, the IRS challenged him and determined that he was not entitled to be taxed as a trader in securities. And this was because his trades were all covered calls on some very substantial long-term holdings this trader had. Now, because of that, the IRS looked at the makeup of his account and found that the vast majority was a long-term hold, and as a result, denied the trader in securities tax status. And this really highlights the need to separate your individual long-term investing from your more active trading that would qualify to be taxed as a trader in securities. And this is one of the biggest reasons that we recommend operating through a business entity as opposed to a Schedule C trader, because it's very clear distinction for that trading activity if you can show that it's occurring inside an entity brokerage account rather than inside an individual account, and hopefully prevent the issues that Endicott was able to see. Gene asks, I live in Nebraska, thinking about setting up an LLC C Corp in Nevada. Any downside? Now, for that circumstance, there's not going to be any big downside with Nebraska. No issue like you would see with California. Then by setting up in Nevada, you do get out of that individual income tax. The only real downside is that you do have the expense of maintaining a resident agent in Nevada, because you will need just someone in the state to receive mail for you, and then the ongoing expense of registering in Nevada itself, which will be about $300 per entity. But for that circumstance, Nebraska to Nevada, it is going to be beneficial to you on a long-term perspective. Tucker asks, I've got a 1099-B consolidated from Natick. How do I account for exchange fees on my Form 8949? Now, with those exchange fees, typically they end up being taken as a deduction through the trading business itself, and so would be reported through the entity's return rather than through that 8949. Larry asks, if the LLC is set up and taxed as an S Corp, can medical expenses be taken if payroll taxes are taken out? And so this is a pretty good point. With an S Corporation, you do have the ability to provide medical benefits to the owners of the business. But those medical benefits are considered to be a compensation paid to you. And so they would be considered taxable income and be subject to payroll taxes on the amount of that benefit. That's why we prefer doing the medical benefits through a C corporation, because you're able to provide those benefits without considering them compensation. Bill asks, I may live in other countries and continue to trade at different times of the year. How would the business taxes compare to personal trading? So we do work with a number of clients who live across the world, and effectively things operate pretty much the same as for someone who was stationary. The home office deduction we were taking would vary as you move from location to location, but in terms of the overall expenses and for the business itself, you would still essentially choose just one state to set it up in, and that would be the main address for the business throughout the year. Simply the only thing moving would be your address and then the different home office deductions as you move from place to place. One thing that I mentioned today that I'd like to go into a little bit more detail on is the self-directed 401k plan, because it is really the best retirement account option for an active trader. With the traditional 401k plans that you may have experienced through a previous employer, you'll be used to the process of selecting an asset mix or some sort of target fund. But with a truly self-directed 401k plan, you have the ability to trade that however you like and use your skills and experience as a trader to grow your retirement assets tax-free. There are self-directed IRAs out there, but we prefer the self-directed 401k plan to those because the annual contribution limit to a self-directed IRA is going to be substantially lower, and you're required to have a third-party custodian. With a self-directed 401k plan, you serve as the custodian for that account and can trade those assets however you like, including a number of non-traditional retirement account investments such as property, as well as trading on margin. With a self-directed 401k plan, you can contribute currently up to $53,000 per year to that account, and that is a tax deduction against your income from trading activities. EW asks, so we don't have to prove residency to establish in another state. And so there's no requirement to have residency in order to establish a business entity in a particular state. You can always form an entity really wherever you like. The only requirement is that you do have someone in the state who you authorize to receive mail and service of process for that business entity. This is typically called a resident agent, and there are a number of different resident agent services out there to provide that service for businesses. But there's going to be no requirement for you to have actual residency in another state to create a business entity there. Bruce asks, are there any particular circumstances that suggest a combination of a C Corp and an LLC? And the circumstances that we'd really like to see for that sort of setup to make sense is if you were an active trader showing profits with at least $10,000 in medical expenses, and that combination of requirements does make it tax effective to have both the C Corp and the LLC. Bruce asks, do you ever recommend a combination of a C Corp and an S Corp? The answer is no. We typically recommend away from an S Corp in general because of the requirement to treat some percentage of your profits as wages subject to payroll taxes. On top of that, well, the C Corp can never be an owner of an S Corp, just one of the requirements for that S Corp tax status. So that's not really a circumstance that we see come up. JT asks, can you use Roth IRA accounts to trade and be tax-free? And you certainly can be trading inside of a Roth IRA to grow those retirement assets tax-free. The downside here is that none of the business expenses are deductible for trading exclusively in an IRA. You do need to be trading in a taxable account in order to deduct those benefits. John asks, what's the best entity combination for trading futures and Forex? And to some extent, that's going to be dependent on whether or not you have a lot of medical expenses. But for futures and Forex, the LLC is typically the best way to go, because under that structure, you are able to maintain the beneficial tax treatments that both futures and Forex trades get with the flow-through taxation, while still being able to deduct 100% of your trading expenses. RL asks, what if I have another business set up as an S-Corp and still want to set up an LLC to use for trading? And with that, there's no conflict whatsoever. You absolutely can have multiple business entities and establish a second LLC to use as a trading business. JT asks, are wash sales applicable to an IRA account? And they are to some extent. When we look at calculating your wash sales for the year, we combine all of your trading activities from all of your accounts. So let's say that if we go back to my example from before, you sell Microsoft at that $23 a share. Then you repurchase it in your IRA account. In that circumstance, the loss gets carried up into that IRA account where it's effectively trapped because it's never going to make a difference to your taxable income. And so IRA accounts can absolutely impact you with wash sales. And that's one of the more really dangerous scenarios with wash sales, because on top of having to deal with the fact that you lose that loss forever, it's likely that you just won't detect that unless you're specifically looking for it, and can lead to additional taxes and penalties. Let's see, and medical expenses would include health insurance premiums. Harry asks, are the rules the same for non-U.S. citizens? And the short answer is it depends. No, non-U.S. citizens are going to be subject to U.S. source income, and so they certainly can be subject to the same rules and can receive benefits from operating through a business entity set up in the States. But there are additional options available to you that a U.S. citizen wouldn't have. But I do believe that that's the time I've been allotted. And so I want to thank you all very much for listening to my presentation. I hope I was able to give you some good information and answer your questions. And if we can help you set up any of this, or you have any questions about it, please let us know. My contact information is up on the screen, and we're more than happy to get in touch and have that 30-minute presentation.